From New York City for our viewers worldwide, I'm Jonathan Ferro. Bloomberg Real Yield starts right now. Coming up, looking for the Fed to remain on the sidelines in 2020, even as US manufacturing data hits the weakest levels in a decade, and S&P takes the most bearish stance on credit since 2009. We begin with the big issue: just how high is the bar to bring the Fed back to the table?
The Fed is on hold.
On hold
this year.
The Fed goes to the sideline.
They're not going to raise rates.
Markets are okay with that.
The threshold for the Fed,
The bar to raising rates
is extremely high.
Pole vault high bar.
impossibly high.
They're not going to be clearing that anytime soon.
The Fed may get pulled back in
They'll have to come back.
if we get a massive escalation in geopolitical tensions.
Conditions have to either worsen
Something quite dramatically happens.
or inflation has to majorly overshoot kind of their level.
They left the door open.
They don't want to be the reason that the markets fall off, but they also don't want to be the reason they're going up.
If the economy's a little bit better, as long as the economy is okay,
They do nothing in an election year.
not going up or down.
They'll probably try to stay off the spotlight.
Joining me around the table here in New York, Diana Amora of JP Morgan and Greg Peters of PGIM. Joining us from London, Andy Chorlton of Schroders. Andy, let's begin with you, sir. Your thoughts on that, the threshold to bring the Fed back to the table in 2020?
I think if we put to one side what happened overnight, because I think that's much more complex and the reaction from Iran will be important. Otherwise, I don't think the Fed's going to be back to the table anytime soon. And I think the same can be said of basically all central banks in the G7. If you look at the pricing, no one's expecting anything from anyone. I think we're in a very benign period, absent any further escalation of the geopolitical issues.
Let's bring the conversation around the table here in New York. Diana, is that your take as well?
I think for now, for the first half of the year, we're likely to see the Fed remain on hold. I think into the second half of the year, we could see them come back to play, especially because we don't see too much of a follow-through on growth in the US, and we expect inflation pressures to remain quite contained.
What's your take, Greg?
Yeah, but I think consensus is right, where the Fed is very much on hold, but a year is a long time, and so a lot can change, and so we learned that just overnight. So I think the base case is right, but I think it's important always to kind of retest that base case and not get too comfortable with it.
There is just a view that the Fed's view of the economy has shifted. They see more slack in the labour market in a way that maybe they didn't before. And the reaction function has shifted. The way they will respond to incoming data is responding to that has shifted too. How big has that change been in the last 12 months for you, Greg? How key is that?
Well, you just look at the dot plot, right? It's been pretty dramatic. And so that really tells you how their minds have shifted. But I still think they're surprised by the lack of inflation, right? So the labor market is still tight, not as tight as they thought, perhaps. But you're not seeing the inflation that I think everyone at the Fed expected. And I think as a result, they'll continue to run this experiment a little hot.
Do you expect to see it anytime soon?
No, not really. I mean, it's firming. It's come off the bottom, but do have a big uptick in inflation? I really don't see it.
Diana, that your take too?
We think inflation will get to 2 this year and will remain somewhere close to that. But I think the Fed will want to let it stay at that level until inflation expectations re-rate meaningfully. So this shift towards average inflation targeting, this is the year it's happening. So I think that's what they'll be putting to play.
Do these ideas resonate with you, Andy?
Yeah, I think Diana's spot on when it comes to inflation. If you do get an uptick in inflation, they'll let it ride. I think people's expectations have become so benign in recent years that inflation is not really the problem. They're focusing on growth or any challenge to the growth outlook. So their focus is more on the other side, I think, than hiking rates to defend against inflation, because they kind of know they can control that side of the equation.
Well, let's talk about rates, Andy. Does that keep a lid on 10-year Treasury yields in and around 2% and lower?
Not necessarily lower than 2%, but certainly in the 2% area. We could easily tick above it. You know, we could get towards 2.25. It's interesting at this time of year. You look at everybody's outlooks for 2020, and lots of people are predicting rates much higher. I think they're looking for volatility where volatility doesn't exist. I think the rate environment is going to be benign. I think it's credit where the problems or the volatility will emerge, not necessarily the problems.
Greg, it's interesting, looking at the bond yield forecast on a Bloomberg terminal, year-end, 193. on a US 10-year, basically in and around where we are right now. But you look at some of the calls out there, SocGen, Standard Chartered, looking for numbers in and around 120, 125 at Citi. Where do you come down on the big rates debate in 2020?
Yeah, I still think it's range bound and sub 2%. And so, we do see a range, a tradable range. But the way I think about it and the way we think about it at PGIM is really quite simply is that the world can't handle higher rates. Right, and that's what we learned in 2018. And sure, the Fed was in play and central banks were moving, but real rates moved up, and that was the killer to risk. And so my number one focus for 2020 continues to be the level of real rates. And if real rates move higher, then I think it's a risk-off environment.
So any move higher is self-limiting because any move higher creates a risk-off environment, and then the bid comes back in?
Correct.
Is that your thought as well, Diana?
It is my thought, and it's been our call for the last year that every time you get towards that 2% range, you should be buying a little bit of duration, simply because the recovery is extremely fragile. It wouldn't take much to tip us back to growth fears again. And then also, let's not forget, the rest of the world rates are in negative territory, and that demand for duration remains very well anchored.
If that story and that dynamic is true of treasuries, what does it mean, Greg, for bonds, for JGBs? Same story?
I think it's a little different in a way that you have an ECB in transition. But absent that, yes. But I guess the fly in the ointment is that the ECB is recalibrating, rethinking the strategy going forward, and I think that adds risk premium into the curve across Europe.
Let's talk about the shape of the curve here in the United States. We inverted last summer. We started to steepen into the back end of 2019. How do you see that materializing in 2020, Greg?
I still believe the bias for the curve is to flatten, not to steepen. And it points back to this real rate argument. But basically, when rates move higher, there's a bid for U.S. assets, and I think it pulls it down. So it's not representative of a decline in economic growth or anything like that. It's more of just a need, right? And to the point where there's negative rates everywhere else, the higher it is above zero relative, the more attractive it is.
Let's build on this, Andy. Your thoughts on how much steeper this curve can actually get in the United States? We had some steepness come through into 2020. Do you think that can continue?
I think it can continue to a degree based off domestic factors. But as Greg says, as soon as you get any reasonable yield anywhere, people pounce on it, which limits the move higher. I think that it makes some sense to have a steeper US curve because ultimately I think you need to price in the risk of inflation picking up. You need to price in the risk of perhaps further issuance at the longer end if the Treasury decides to shift there. But to Greg's point, I think things are going to be limited because people continue to buy the US market in the absence of anything else worth buying.
Greg, how important has the balance sheet operation at the front end of the yield curve been for some of the dynamics we're discussing at the moment?
I think it's critically important, right? And so the big hiccup that we had in the market, the thing I was really concerned about going into year end that the Fed alleviated was really what's going on in funding, right? And have a well-functioning funding market is critically important to fixed income and the movement of capital. So the fact that the Fed has stepped in, there's still more work to do, but injecting kind of that front-end program has been really important. So I expect that to continue until there's other fixes.
Do you think we've addressed some of those funding issues to the point that they can begin to think about backing away again?
I think it's too premature for that. They have to lay out a roadmap, and there's other things that are beyond their control and much more difficult just from the regulatory standpoint. The fact that banks are penalized to own treasuries is something that maybe should be altered.
Well, Greg, the kind of thing that I'm trying to think about through 2020 is to what extent the Fed will be backed into a corner with the balance sheet, that they'll find it very, very difficult to back away from the kind of operations they're conducting at the moment. Even if the issues in front of them are addressed, they'll be left with a separate issue that we have a market now in some areas. Many viewers that watch this program will disagree, but in some areas believe this is QE. And because they believe it's QE, they're bidding up risk assets. Then if the Federal Reserve starts to say, you know what, we've solved some of the issues in funding markets, we'll back away from some of these operations, then what happens if you start to see a sell-off in risk assets as the balance sheet starts to go the other way again? What do they do?
No, well, it is a conundrum, and I do think it's really difficult for them to get out, right? And I think that's going back to the ECB experience where they feel trapped, and the same with the BOJ. So the Fed doesn't necessarily want to be trapped, but I think they are. But this isn't QE, it just looks and feels like QE. And the difference is that there's no duration to it, and so it doesn't have the same kind of impact. But there's also talk in some circles on how they're going to help funding by going out the curve, which is decidedly QE.
Diana, final word on that?
I think it certainly trades like QE. I get the point on duration not being bought, maybe not anchoring the yield curve, but the amount of reserves in the system is increasing. The Fed is increasing liquidity, and that is the QE-like impact we're seeing in equities, in risk assets across the board. So I do feel at the point where the Fed stopped doing this might be a little bit tricky for markets to maneuver this year.
The guys around the table here in New York and our guest in London will be sticking with us. Coming up on the programme, the high-grade bond market gearing up for a big month of sales following a slow December. That's coming up next. This is Bloomberg Real Yield. I'm Jonathan Ferro. This is Bloomberg Real Yield. I'd like to head to the auction block now and begin over in Europe, where the primary market is starting to shake back to life with a handful of deals to close out the week. 3 sterling offerings in the spotlight, including sales from EIB and Nationwide Building Society. In the US, the high-grade market gearing up for a $120 billion month of sales after pausing for much of December. JD.com and Reinsurance Group of America making up the thin pipeline that's expected to grow in the coming days and weeks. And it could be a busy month for US high-yield issuance. Roughly $9.5 billion of junk bonds scheduled to mature for or be called this month as companies look to refinance debt while borrowing costs still remain cheap. Sticking with credit, where S&P Global Ratings was the most bearish on corporate debt in 2019 than at any point in the last decade. Last year seeing the most downgrades for US companies relative to upgrades since 2009. With me here in New York, Diana Ramoa and Greg Peters from London, Andy Childen. Your thoughts on that, Greg? S&P very bearish on the ratings of credit in the United States last year. We know the story in the price action, very, very different.
Yeah, so I mean, they've really given companies the benefit of the doubt over the past 5 years. So, I mean, there has been a slowdown in cash flow growth. You know, you've seen that manifest itself in earnings, right, if you're an equity player. And so this is just somewhat of a topping off. So I don't view this as a really horrible trend per se. It's a little slow to react, as quite frankly, the years prior, there's been so much leverage put onto these balance sheets that they quite possibly didn't deserve those ratings in the first place.
Andy, let's bring you into this conversation. When you hear things like the most downgrades relative to upgrades since 2009, people worry when they hear the number 2009. Should they be concerned about the credit ratings of some of these companies relative to where they're priced currently?
I think the pricing is the issue as opposed to the fundamentals themselves. Pricing and fundamentals the pricing has got way ahead of the fundamentals because of the QE, because of the search for yield we talked about in the previous segment. I think what we'll see in 2020 is much more dispersion amongst credits, particularly in investment grade. You saw it, I think, in high yield last year, where the triple Cs didn't do so well, and very few bonds yield the index, so to speak. But I think you'll see companies that are on top of their deleveraging plans, following it through, will be rewarded, and those that don't show discipline will be punished, because there's no question that prices are very expensive of credit. You do not get the kind of excess returns that we had last year across pretty much every sector. And you're not able to get that again this year without something materially changing. So I think people should be cautious in credit just because of the entry point they've got at the moment.
You agree with that, Greg?
No, not really. You should always be cautious in credit, right? Because it's a scary place because there's nothing but downside and the upside's very limited. And that's very much the case in 2020. But I still think it's a pretty decent environment for credit. So pricing has definitely come a long way in a short period of time. A lot of that, though, was just a reversal of the prior year. But I think, you know, unless you see a real uptick in defaults and companies continuing to trash your balance sheet. So while you know there's been more downgrades, you haven't seen companies actually look to impair their balance sheet. And what I think that's really important. So I think it's too early to sell the credit rally. And I think there's way too much negativity around triple Bs, and I think there's way too much negativity around high yield bonds in particular.
Well, let's talk about triple Bs and high yield bonds. Triple Bs had their year in 2019. Regardless of all the concerns coming into the year, they had a fantastic year of performance. Triple Cs did not until December of 2019.
Yes.
Are you on that bandwagon now for 2020?
Yeah. So I think we were on a show back in November, and you asked me the question, and I thought it was time to dip in. It was too early at the time, but there's been such a big price dislocation there. And so to us, there's much more value in single Bs and triple Cs versus double Bs, for example. So I see value in triple C part of the market. I see value down in the capital structure, at least for now. If pricing changes, then we'll exit. But as of right now, we see value.
Do you share that view, Diana?
I think you still need to be fairly select, but in this backdrop where the Fed's balance sheet is still increasing, you have relatively easy monetary condition, there is money to be made in dipping a little bit further down the credit spectrum. I think for the first part of this year, it's not going to be a nuanced rally. Everything should be supported. Barring a shock, a geopolitical shock, but everything should be supported by the external backdrop. I think where nuance counts is later on in the cycle, and I thought the S&P report was quite interesting because the things they're talking about are things markets have talked about for a long time. Autos sector, which has been the problem child, is something they're flagging as potentially one that could need to be adjusting more. Whereas we have seen a little bit of improvement in some of the other sectors like telcos. In the triple C part, it's the energy stocks that have really underperformed. So I think for us, it's more, you look at it on a sector by sector basis and you try and look for where there's improvement, or at least where the valuations compensate you for that risk.
You mentioned the auto sector. The credit team here at Bloomberg crunched some of the numbers that S&P did with the revisions to the credit ratings. 11-to-1 was the downgrade to upgrade ratio for 2019 in that sector alone, which is absolutely terrible. But to Greg's point, if you're going to start looking at the areas of the market that didn't do so well, that lagged in 2019, is that a sector, an area you'd be willing to look at? And if we get some kind of stabilisation in the economy, is a cyclical tailwind enough to offset what are very big structural issues in that particular area, that particular sector?
It's again on a very much on a name-by-name basis. I think the structural issues, so in the US, we're talking about market saturation. That's not going to go away. The sector may have gotten a boost from what the Fed did last year, so consumer credit becoming more accessible. But again, it's very much on a name-by-name basis. Some of the triple Bs, autos, are expected to be downgraded to high yield this year. Markets are already pricing that in to an extent, so there might be some value there where the bad news is in the price. In Europe, I think the balance sheets starting point is a little bit stronger there. Balance sheets are a bit stronger. Some of the names have been hit hard, such as Volkswagen, which was forced to actually get up to speed with the regulatory environment much sooner. Again, very much on a name-by-name basis rather than a sector-wide. I think long-term challenges for the sector will remain with us.
Quick final word, Andy, on the auto sector. Your thoughts?
I think, as Diana said, there's some fundamental problems that need to be addressed in terms of the change in that sector. It's similar to the energy sector, in my view. It's going through a whole fundamental change in how people buy cars, how people look at cars and the type of cars that they're buying. I think the challenge with Europe, Diana mentioned Europe, just looking more generically at European credit, excess returns of European credit last year were over 5% for an index that yields about 50 basis points. So I don't really understand how people can come into 2020 with a particularly bullish view on credit, given the returns we've enjoyed in 2019. I think autos, as Diana said again, kind of it's going to be name by name, but at least in that area where there has been some underperformance, there's maybe the opportunity to pick some names that do deliver and do recognise the challenges that they're facing. But it's another sector in transition like energy.
Final word around the desk, Greg.
No, I think it's still time to be invested in credit. And so I think it's too early. It's name by name, it's dispersion, but I still think it's a place for alpha.
Guys around the table, sticking with us. Still ahead, the final spread, the week ahead featuring a slew of Fed speak and the December payrolls report. That conversation is coming up next. This is Bloomberg Real Yield. I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the final spread. Coming up over the next week, FOMC presidents taking centre stage with Charles Evans, John Williams, Jim Bullard and Fed Vice Chairman Richard Clarida all speaking in New York, plus some big economic reports out of the United States, including factory orders, ISM non-manufacturing numbers, and then the main event next Friday, the US payrolls report. With me around the table here in New York, Diana Amoah, Greg Peters and Andy Chorden. Diana, just to pick up on where we left off this week and ended the week with a really weak ISM print for manufacturing here in the United States. Should we be worried about what is happening in
Well,
the manufacturing sector in America?
I think that's been one of our big concerns, that the markets were getting a bit ahead of themselves, and that's why we still think being in duration in the US makes sense, because the economy is not picking up to the extent that markets seem to be anticipating, at least certainly equity markets. I thought the ISM print today was poor across. I mean, when you look at the underlying data, different components just showed general weakness, and the employment component actually also came in lower than expectations, which should make next week's payrolls data quite interesting, given the markets expect a fairly robust print, so around 150, 160 is expected. I think if we see any downside for that, markets might have to rethink the Fed again.
The approach at the moment, Greg, I think the hope more than anything is that if you see stabilisation in China, which we are arguably, and then if you see it in Europe, the US will lag the manufacturing recovery. It won't lead it because it was the last in, therefore it will be the last out. Is that the right approach to thinking about this issue?
I think it's more concurrent. I mean, clearly, Europe has been caught in between the U.S. and China, and so they should definitely react. But I think, you know, they're separate. And so just because the U.S. entered last doesn't mean that it also, you know, not be the first to exit either. So, like, what I think people are a little too negative on the U.S. in terms of that. But it bears watching. But what today's number told you is that, man, the consumer better hold up, because that is the key driver to the economy.
So far, so good. So far, so good coming into 2020. Guys, let's get to the rapid fire round just quickly. 3 quick questions, 3 quick answers if you can. First question, can high yield credit spreads in the United States break through 300 basis points in 2020? Yes or no? Greg?
Yes.
Andy?
No.
Diana?
Yes.
2019, the year of triple Bs. Will 2020 be the year of triple Cs here in the United States? Diana?
No.
Andy?
No.
Greg?
I'll go with yes.
And your third and final question on the US 10-year. Can we retest the 2019 lows on 10-year Treasury yields? Yes or no? Andy?
No.
Greg?
Yes.
Diana?
Absolutely.
Guys, great to catch up with you all. Diana Ramoa, Greg Peters, Andy Childen from New York. That does it for us. We'll see you next Friday, 1 p.m. New York time, 6 p.m. in London. From New York, for our audience worldwide, this was Bloomberg Real Yield. This is Bloomberg TV.